Welcome to Just the News. Please subscribe, like, share, and comment. Gordon Johnson says the bond market and the stock market are calling the Fed's bluff. He added that inflation is too high for the Fed's current benchmark rate of about 2.5%. He suggested that investors should reacclimate to shorting stocks. On days this year that the Federal Reserve raised interest rates, the stock market rallied significantly. And then the day after each raise, it sold off significantly. This is the pattern that Gordon Johnson, the CEO and founder of GLJ Research and an analyst of about 18 years, has observed since the fight to tame inflation began in mid-March. For example, after the Fed announced its second hike of this cycle on May 4, the Nasdaq 100 rose 3.4%, he said. The next day, the index fell 5%. On June 15, a similar pattern unfolded. The index was up 2.49%, only to drop by 4% the following day. It would seem the market is sending mixed signals about the efficacy of the Fed's rate hikes. Johnson felt the same way about Jerome Powell's speech on Wednesday. While the Fed chairman sounded hawkish on the fight against inflation, Johnson believes the current rate hikes aren't enough. His firm provides in-depth coverage of companies in sectors such as steel, iron ore, electric vehicles, solar energy, lithium-ion production, and cannabis. He told Insider that he has pegged about 85% of stocks at a sell rating. His outlook is bearish for the rest of the year, to say the least. June's Consumer Price Index, which is a measurement of the change in prices for goods and services, increased by 9.1% from a year ago. The Fed's current benchmark fund rate of about 2.5% is still way too accommodating, he said. He believes the central bank needs to get extremely aggressive or inflation will stay elevated. The Taylor rule suggests that the Fed funds rate has to be at CPI inflation for inflation to start to come down. So them doing 75 basis point hikes, while large in some people's eyes, is still a joke, and that is what the market is saying, Johnson said. It's clear that Powell is focused on getting inflation down to 2%, he noted. But this can only be achieved through declining economic activity. Yet, nominal spending continues to grow at an accelerated rate fueled by high wealth, high wage growth, and high credit growth, he added. All of these factors would need to significantly slow down before inflation can be tamed. As of now, these variables have yet to show signs of a slowdown. He pointed to year-over-year credit growth, which is trending at all-time highs. Wage growth also remains strong at 6.7%, also at historic highs, he noted. Finally, household net worth rose to a record $150 trillion earlier this year, and it's still sitting at near all-time highs, he added. If that's not enough, the bond market is also sending a contradictory signal. When interest rates are raised, bond yields should be going up, but that's not what's happening, Johnson said. Yields on the 3, 10, and 30-year bonds are going down. This is because the bond market, along with the overall stock market, which keeps rallying, is expecting rates to be cut in early 2023, which means it's basically calling the Fed's bluff, he noted. Investor beware. Johnson believes there's about to be a significant reduction in overall economic activity, including lending, debt availability, wages, and asset prices in stocks and real estate. Thanks for watching Just the News. Please subscribe, like, share, and comment.